Mike Mayo with us, truly in celebration of Exile on Wall Street, one analyst's fight to save the big banks from themselves. A guy named Volcker wrote up a blurb. Let's bring up the Volcker blurb right now, if we can. I mean, blurbs are blurbs, but then there's a Paul Volcker blurb. That's pretty cool. Mike Mayo is an old-style bank analyst, thorough, independent, honest, who never pulls his punches, whatever icons, public or private, may be wounded. Why are you so reviled, if that's the case?
I feel as though shareholders are treated like second-class citizens. I feel like they were treated like second-class citizens 2 decades ago, 1 decade ago, and still the place now. So if I say things that might impact the compensation of some of the bank CEOs, right, if I complain about some of the accounting, if I complain about some ill-conceived incentives, it goes against the wallet of some of the people running these banks.
Goes against the wallet. Is there a Chinese wall still between investment banking and the sell side? Folks, a lot of jargon this hour on Wall Street, but keep up with this. It's going to be fun. Investment banking, let's do a deal. Sell side, where you are and where I was. Sell side's over here, which is we got to make money. Is there really a wall between them?
When I say incentives are out of whack, I'm talking about the bigger picture here. So I'm talking whether it's the rating agencies or accounting firms that get paid more by the companies they evaluate than the end investors. I'm talking about regulators who get more power by regulating more entities as opposed to looking after the taxpayer. I'm talking about people inside the banks who have blown the whistle. You saw the guy, Mr. Bowen at Citigroup, who raised the alarm about mortgages at Citigroup, and he was pushed aside. I'm talking about politicians who enact legislation that encourages votes as opposed to longevity of an expansion.
Would you suggest that PricewaterhouseCoopers should have blown the whistle on MF Global?
There's a lot of information coming out, but I will say, and another guy on my team analyzes that company. He had an underperform rating. He did very well.
Congratulations.
But that reflects the crisis of confidence around the numbers themselves. You still can't trust the numbers at some of the big banks.
Dreaded first chart. Let's bring it up here. Bank of America. What a train wreck this has been, and you've been on this. It's Mayo's fault. Everything today is Mayo's fault. The stock goes down. Is it because of the sell side? Is it because everybody piles on Moynihan? Why is the sell side so held at a distance from people? Why can't you get on a conference call if you want? I mean, tell me about the relationship right now between these major banks and people like you.
Well, I write about this in the book, and I say these managements of the banks, or really any big company, how often do they talk to a shareholder, to any shareholder? Once every 3 months. And how long do they do that for? 1 hour typically. And at the end of this 1 hour phone call every 3 months, they say, well, we're out of time. We can't take any more questions. Is that treating your number one owner, the shareholder, the way they should be treated? If this was a private company, would you, let's just say you and I just own the company, would we run it the same way it's being run today? When you think about that, you almost laugh, because of course you'd be talking to the management more, of course you'd require them to spend more time with you, and of course you'd require their auditors to give a final report that gives us information instead of just
another chart. I got 2 questions off this chart. This is the Keefe Bruyette Bank Index, KBW Bank Index. It's still Mayo's fault. There's the bank index. Critically, as you go to the right side, Mike, is that going to be a range-bound financial system where you would rather allocate to other sectors than your area of banking, or can the banks recover?
I still recommend selling bank stocks, to be underweight bank stocks. Every meeting, bar none, every meeting I've been into with investors over the last year or 2 years, I said underweight the bank stocks. I'd rather be elsewhere. This is going to be the worst revenue decade for U.S. banks. It's the decade of the Great Depression. Okay,
let's get right to that. Critically, nominal GDP has been tepid. You saw the bank revenues really struggle this quarter. What was the one signal you got from those conference calls about the top line of the income statement?
You want one statistic?
Well, I'll take 2, but give me one.
I'll give you one.
Give me one, because we got to go to break.
Okay, our theme is we're a lighter version of what took place in Japan. The yield on the assets on bank balance sheets have gone from 6.5% to 4.5% in the last 3 years, just like what happened in Japan the first 3 years. But in Japan, you know where that 4.5% return went? Down to 1.5% over the next couple of decades.
So we're going to see it squeezed down here.
Margins are getting squeezed. Not that much, but they're getting squeezed.
We have so much to talk about. Mike Mayo with us. Folks, a terrific book, Exile on Wall Street. I remember the day he was canned at Credit Suisse 11 years ago. Infant baby, out the door, sell recommendation, goodbye. Mike Mayo with us. You know him, Credit Agricole, CSLA, Exile on Wall Street, one analyst fight to save the big banks from themselves. I want to keep on nominal GDP. Bring up the number right now. And this is about this margin. I'm making the margins here. This is from a Mayo note. 20 basis points, that's 0.20 percentage points, suggested margin compression by BB&T in the next 5 years. That's just this idea of they get squeezed, right?
That should be next 5 quarters.
5 quarters, excuse me. That's my fault. That's my fault. I was wrong. Make note of that. Next 5 quarters. Tell us about the margin compression out a year and a bit.
Well, there's just no way of getting around it if you're a large bank, that the loans and securities are repricing at lower rates. In other words, when they mature, you reinvest at low rates, and your funding costs aren't going a whole lot lower. You get squeezed. This is a terrible environment for banks, a flat yield curve at low rates.
Is too big to fail in here? You really say its size is not what the issue is?
Well, I do believe it's more of an issue of management over model. Having said that, if you are a large $2 trillion bank and you haven't gotten the job done over a long period of time, it's enough staying in the major leagues, be sent back to the minor leagues. I think that would be more valuable. And here's the key point, more valuable to the shareholder.
Okay. Let's bring up this first quote here. Exile on Wall Street. As it turned out, my negative call on banks was correct, but I was fired anyway. After working so hard for 7 years to go to Wall Street and hustling for another 8, once there to do my best work, and I was out. Let's go back to Credit Suisse. Why were you fired?
Well, there was a big story in a magazine that talked about the reasons why I was fired, and that it's tough. The title of the story was The Price of Being Right. In other words, if you say sell on Wall Street, there's all sorts of backlash. So as discussed,
even still today. We've moved on from Jack Grubman, who's in your book, and we've all gotten a little grayer. It's the same today when you put a hold or a sell on?
It's still extremely difficult to have a sell rating if you're a Wall Street analyst.
Because of the executives at the bank, Mr. Pandit, Mr. Parsons, and others, or because of your bankers if you're particularly at a banking house?
I'd say one way or another, I think there's still some pressure through the companies that the analyst is covering in the first place. I testified about this in 2002.
Yes, you did.
And I gave a whole list of types of backlash from corporations against analysts. And if you told me almost a decade later you'd still face that sort of backlash or pressure from companies, I'd say I don't believe it, and that's where we are today.
If Leo Tillman talks about we need risk in the system, we need corporations that monitor risk, and we need executives that are smarter about the math, you're a CFA, I'm a CFA. Are the executives smarter today than they were 15 years ago?
Well, take a look. It's not a matter of how intelligent you are. It's a matter of can you even uncover the problems. Robert Rubin made over $100 million last decade without having operational responsibility. He's the ex-Treasury Secretary of the U.S. government, and he said he did not understand that those CDOs were out there almost bringing down the bank.
Let's talk about the education. This is the funniest part of this book, and there's some real light touches as Mike Mayo goes through 20 years of work here. I asked her to carry flashcards with various topics and quiz me repeatedly. Despite this chore, she is now my wife and has been putting up with me ever since. After I got through the CFA process, I wanted to take the next step. What'd you do, propose after level 3? I mean, come on. This is torture. I did not make my lovely ex-wife do the flashcards on the CFA. Why did you go through this process like I went through it? A wonderful guy said it's a rite of passage. You get smarter, and then you're not allowed to have an independent opinion, are you?
Well, my wife can't claim there was a material omission about my personality. But I would say I've practiced the job for the last couple decades the way it's taught in the CFA. You say buy, you say sell, you do research reports, and that's the way the system is supposed to work. But from 1993, when I read a report on Key Corp and got backlash, to 1999, put sells in the banks and got fired, to early 2000s with the backlash from Jamie Dimon, which I write about, to 2007.
Did he call you and apologize?
As I write about that in the book. And so in front of hundreds of people, he made fun of my stock picking record.
Okay, fine. That's okay.
But then
that's game.
The next day, well, no, it's incorrect, though.
It may be incorrect, but you guys get beat up all the time.
Well, you can't misstate my stock picking my record, because that's why investors butter my bread. That ultimately I must have good recommendations, good insight into the company. So I took that as a very serious moment. And that's one of those situations where you say, I don't care what happens. I'm going to resolve the situation regardless of implications. I put out a note, and then the next day he did call and apologize. So he cut through all the bureaucracy and called me. But at that moment, I had no idea what sort of backlash I might face. In that case, I didn't face it.
Interesting, interesting. When you look at the way you get backlash, is it over your thoughts, your concept, your discussion of management, or is it over the spreadsheet in the back about the ratios or the gaming of revenues or net income?
It's really limited by the imagination. You have companies literally calling the press, giving them information. You have companies making jokes about analysts to other investors, again, the people who butter my bread. You have lack of access, whether it's questions on conference calls or visits to the companies, or once again, bad-mouthing your reputation to other investors.
Mike, we got to bring it forward here. Negative 277 the Dow. Here's Joe Nacera in New York Times today on Governor Corzine. Crashes like it's 2008. If the governor left MF Global because it was sold as $11 million in options would immediately vest, he'd get $12.1 million golden parachute. Of course, the proxy statement doesn't call it a golden parachute in on. Your thoughts on MF Global? And was this from the most senior management, or was this a more systemic MF Global issue?
Well, we talked about the Japan light scenario in the U.S., and if you're not going to have very fast growth, you need to accept that. Our whole country needs to accept that. I talk about that in the book a little bit. The best performing bank the last 3 decades, you know where they're based?
Where?
Buffalo.
M&T.
Yeah, first. So if you accept slow growth, you can be okay, but they didn't accept slow growth. They reached for yield. They bought European sovereign bonds, $6 billion, and then they blow up. So if we accept slow growth and accept a muddle-through scenario, then it could be worse. And that's what happened with MF Global. That's an example of worse.
Did you learn to use a slide rule? Did you use a slide rule?
I had punch cards on my first computer, but I didn't use a slide.
I had Fortran punch cards. This is scary. Mike Mayo on Fortran. Talk about that. You made your wife use flashcards? It's a break exclusive. He used punch cards for computers. The future of Wall Street, in celebration of Mike Mayo's exile on Wall Street, our chief financial correspondent, Christine Harper, joins us. Bring up a quote here from the book. This is like we're going to get religious here with Mike Mayo. I never had to resort to the kind of Old Testament vengeance. An hour or so later, I got a call from a Dow reporter covering the story who said he heard that Dimon had called me personally to apologize. What makes Jamie Dimon's conference calls different?
Well, Jamie Dimon is part of J.P. Morgan. So J.P. Morgan, for all the problems of the banking industry, at least they come forth with unfortunate news. So at the start of the crisis back in 2007, they said some of these mortgages were going to go bad before others did. He talks about the issues of the industry. The last conference call he had, he talked about the outlook for the next year. No other bank talked about the outlook for the next year. So he tends to come forth with more information than other banks. He tends to cut through bureaucracy a lot more. So you referred to the book. After I put out a note criticizing what Jamie Dimon said about me, I didn't know if he'd called my boss, our top attorney, the CEO of my firm, some regulator agency, but he called me directly. So Jamie Dimon tends to cut through the chase.
Is that your single best buy with your cautious view on finance?
No, I would not say that's the case.
What's your single best buy?
I would say right now we'd go with PNC. That's the only regional bank I'm recommending. They're a very safe bank. They're not exposed to Europe, and they have some benefits still there from an acquisition they did a couple years ago.
Right, Christine, dive in here. Ask a question.
One question. I mean, I was just telling you during the break that I think your book is coming out at the ideal time because there's never been an example for investors in the banking sector of how clearly you can be killed by lack of transparency, lack of accountability. I mean, the collapse of MF Global is an example, but everything that's coming out about European exposures as well. My colleague Yalman Onaran has a great story out today about how it's not very clear how much CDS on these European countries these big banks have sold. And if you look at BIS figures, they've ballooned in terms of the exposure these banks have, but the banks' numbers themselves are not anywhere near that. So I'm just wondering, how comfortable do you feel that these banks have really come clean on the levels of market exposure? It might not be direct to those countries, but it might be a CDS contract they've sold to somebody else on a European country.
The biggest fear of an investor in a financial stock is what you don't know. And MF Global is a reminder of that today. It's always a black box when you invest in a financial. So you need to be comfortable with the CEO. You need to be comfortable with the systems, the track record, and little telltale signs. And this is simply a reminder that that risk is still out there. It's not just with regard to Europe. It's also with regard to U.S. mortgages. Have the banks really marked to market? They never marked to market, but they've really recognized the full extent of losses. No way. It's not a close call. At the peak of the crisis, I thought they had $1 trillion of unrealized losses. Today, I think that's about $300 billion. So you've gone a long way, but you still have more to recognize the values, even before you consider the European situation.
So if there's one single thing that you wish, as in your role as an analyst, and we in our roles as journalists as well, that you wish that these banks would provide in terms of information that you don't feel you have a good sense of, what would it be?
It's the information, but it goes beyond that. I feel as though shareholders are treated as second-class citizens. So I would say give shareholders and those who represent them, like me, especially the shareholders, more say in which managers stay, which directors stay, their overall compensation.
Here's a quote that's inflammatory, page 113. Pandit's action in signing the 10K may have been more than simply dishonest. I believe it was flat out illegal under Sarbanes-Oxley. I mean, this is serious stuff that you're alleging here. When you're on a call or you dive into the notes, what do our viewers need to be aware of when they see the strength of this language? What'd you pull out here?
Well, first you go, well, what more information do we need? You can have all the information in the world. At the end of the day, we need CEOs who are held accountable for the financial information. So I don't like reams of regulatory stuff. I was the only analyst to testify to the Senate Banking Committee in 2002 about Wall Street conflicts of interest. If you said we'd be here a decade later, I wouldn't believe it. But part of Sarbanes-Oxley, and it's a lot of bureaucracy and part of that, but the CEO is supposed to be responsible. So he needs to be responsible for what's signed in that paper. So even if it didn't violate Sarbanes-Oxley, in my opinion, I thought he did violate Sarbanes-Oxley when the CEO of Citigroup, Valentine's Day 2008, got a letter from regulators, the OCC. 8 days later, he signs his name saying everything is fine. From the outside, we can't know if everything's fine. We need the CEO and the directors to say.
Management.
And so either have them have 90% of their net worth or 50% of their net worth, more skin in the game, or let's have at least some more information or them be held responsible for their name on that page.
How bad are the layoffs going to be? This has been a big debate between me and Christine. We're starting to see it come out, but how bad are the layoffs going to be?
Has been, where are they going to be worse? You've been expecting more in the retail sector.
I think there's a bank on every corner. Do we need a bank on every street corner?
I think I said this already. This is going to be the worst revenue decade since the decade of the Great Depression.
How bad will the layoffs be?
Well, I want to give a reminder here, because you think, oh, bankers bad. The average banker in the U.S., there's 2 million bankers in the U.S. You know what the average salary is for the average banker? $82,000.
Brilliant.
All right, so realize who's big. Yeah, you're going to have layoffs on Wall Street, but you're also going to have layoffs on Main Street, because most of the banking industry is Main Street, not Wall Street.
Where are the worst layoffs going to happen, though? Wall Street or Main Street? Main Street banks, I mean.
The industry is behind the curve. We've been writing about this Japan theme for a couple years. You're not getting the revenue growth back. Everyone's looking around the corner saying it's coming, it's coming. Maybe this is the destination for this decade.
I want to come back. This quote is powerful. We're going to go to break with this quote. This is the single most important quote I've seen from Mr. Mayo. Let's bring it up here. This year, U.S. bank revenue growth should be the worst since 1938. The question, which banks next year might show down earnings? That from Mike Mayo. Mike Mayo with us, Credit Agricole. Exile on Wall Street is a new book, movie rights and negotiation as we speak. Here's the quote. Bring up this quote. Jump on that, Victor, if you would here. The reason that banks need to feel the consequences of their actions is because typically, this is great, they're not meant to be growth stocks. They're not supposed to grow at warp speed or somehow discover a loophole in the basic rules of finance. Simon Johnson nailed this in 13 Bankers. Why do we think these are supposed to be growth stocks?
I still go to the root cause being some of the incentives and the compensation schemes that encouraged excess risk. You make a lot of money, you get paid more. In 1999, I put out a report highlighting stock options in the banking industry. Remember, we had those in the tech industry? You know which bank had the most aggressive use of stock options among all large banks?
Which one?
Citigroup. Lo and behold, they did a lot of acquisitions, took more risk, and then they blew up. So the upside is you make a lot of money. So
are they free and clear right now?
When you say free and clear,
is the level of struggle better than 2008 at Citigroup?
Oh, it's certainly better than 2008, but do I think they've changed the DNA from the last few decades? No, and that's why I write about that in my book.
Christine, question, please.
I mean, you write in your book also about the importance of shareholders getting more of a say in the way that the companies they own are run, instead of the management getting to do so much on their own. Why is it that hasn't happened? Why have shareholders, it seems to me, very often been willing to sort of passively accept what's going on at these banks, vote in these directors, over and over again, accept the pay? I mean, we've had Say and Pay instituted this year, and there has been very little reaction to the banking
When's this
pay.
going to change?
Well, I think the SEC could make it easier for shareholders to get involved. And people say, oh, activism. Let's not separate into activism or not. How about the middle ground, acting like a long-term shareholder, where you get involved in the pay of the executives? And I don't care about people making a lot of money if they earn it. It's just make sure the incentives are aligned. And getting rid of bad directors and advising them maybe, okay, this is empire building as opposed to creating shareholder value.
You must hear, as I do, from a lot of investors, why bother? Why try to fight Citigroup when I can just put my money in Apple? What's the point? Why should I be in
We asked this before. This is the key question. And you said before you would be wide of the banks for the next decade.
Why I think this will be the worst revenue growth decade since the decade of the Great Depression.
When are they going to consolidate if that's the case? If the banks are, as Christine says,
they're cutting back, they're becoming smaller, shrinking.
When do they finally merge, not to a Canadian equivalent, but to a much more normal equivalent?
Well, I thought there'd be more consolidation by now. If you're not getting on the revenues, you're a lot more efficient than you were in the early 90s. You need to create new efficiency gains. You can do that through mergers. That's one way.
One question to Christine. What have you learned? We're going to have to go here, Christine. What have you learned in the last few days about major Wall Street banks?
Well, I think there's a huge advantage in being too big to fail. We're seeing that right now. We're seeing, a bigger reaction in the stocks of companies like Jefferies right now to what's happening at MF Global than we're seeing in companies like, Goldman.
Will MF Global be sustained? Will it be held within?
I would love to get Mike's view of that.
Think?
MF Global. Someone else, my team covers them. I'd rather not go there.
In the system, are they going to be part of a domino chain, or is that not something we have to worry in 2011 about?
They have $40 billion of assets, or had $40 billion. The big banks have $2 trillion.
Yeah.
So they're not up there with the big banks.
Okay, let's go. Christine Harper, thank you so much. We're going to come back with Mike Mayo in support of Exile on Wall Street. Note of the day. It's got to be for Mike Mayo, of course. This is his note on MF Global, followed by Credit Agricole. MF Global is a warning sign that when banks look for ways to boost revenue in a slow growth environment, the result can be losses that far outweigh any intended benefits. Simon Johnson wrote that paragraph 5 years ago. Exile on Wall Street. Here's a quote from the book. Taking from Gross and Elarian, the new normal, relying on companies with effective risk management is more important than ever before in the current generation, since the margin for error is so low. This, excuse me, from a research note. Again, this compression down to an old style banking. Do you have any indication they'd like to go back to a utility banking?
Well, you don't have a choice. In the case of MF Global, they did not choose to have better risk management, and they had problems. Do they want to go there? This is new in the generation of bankers that we have. No one's lived through such a slow growth environment. They have no choice. They're reluctantly being dragged along. They're trying to get expenses under control, but I'm still not convinced they get the full message. I wrote the same thing back in 1999 saying, don't grow loans too quickly. Last decade, banks grew loans twice as fast as nominal GDP.
What do the Canadian banks get right?
In the U.S., we've had a lot of competition, and it's one trying to up the other one. And so you lower the quality of loans, and you say, well, one company's doing this. Well, let me top that and do that. And it was a race to the bottom last decade, which I'm not an expert on the Canadian banks, but I know that the degree of competition during the crisis was more unique to us.
Here's something. I want to get this with Christine, but I'm glad to have it with you. This is just simply the ratio of Goldman to Morgan Stanley. Is there a retail future? And it's just been an outperformance up of Goldman for a long time. Morgan Stanley has retail brokerage and all that. What is the shop, this I hate this word, synergy of banks going to be? Is it going to be investment banking and retail deposits, or can it be a supermarket strategy as we dreamed of 20 years ago?
Well, I still think it's management over model. In the case of Morgan Stanley, I think they have great potential. I actually think Citigroup has great potential if they got their act together. In the case of Morgan Stanley, in my research report, I said new management, new CEO, new strategies, trying to get a 20% profit margin in the brokerage business. And I said, surprise, this is from my 2005 report.
Yeah.
So they're repeating the whole strategic plan from 5 or 6 years ago. So they need to get out of that funk they've been in the last decade.
That phrase, that Mike Mayo phrase, get their act together. What do you need to see Mr. Pandit do?
Well, I need CEO of Citigroup to go ahead and be more convincing that the risk management is in place, that the transparency is there, that they're going ahead and following the corporate guidelines. Here's corporate governance and business practices of Citigroup. You know what year this is?
Bring it right over here. Victor, grab this if you would.
2005.
There it is. Spring 2005.
Go ahead and take a look at that and see if they live by those corporate governance practices.
This is TV. I have to look at documents? Wait a minute.
You can read from that.
No. Citigroup has long embraced strong corporate governance. Governance is a rage today. What does governance mean to you?
Governance means making sure that the incentives for the people at the top are aligned with shareholders. In the case of Citigroup, that's not the case. I estimate that the incentive compensation for the CEO of Citigroup was in the money, above the threshold, 3 months after it was agreed to.
Okay, but this is an important chart. I just invented it today. Mike, this is Europe. This is the difference between Ireland and Italy. Italy becomes Ireland, and that line on the right, cascading down, is how much the Italian yields have come up to meet the Irish yields like this. Here's Ireland, they're lousy. Here's Italy, coming up quick, and that line comes down on that chart. Mike Mayo on Europe, what are you looking for in Europe right now?
Well, the new news is Greece, which we know about, the referendum. But there's 3 items that we're watching in terms of Europe. One is Italy, as you say, to have real structural reforms. By the way, this whole European situation, it's a lot of re-engineering, financial re-engineering without the structural change, and we need to watch the structural change. Number 2, we need to watch France to make sure that the government debt rating is not downgraded. And then number 3, we need to see where the money is going to come from for the EFSF. Who's committing all this money and what are they getting in return?
You know,
at COSA, we have a strategist, historian, and economist. They're usually arguing in different pages. They're all 3 on the same page saying that this resolution was dead on delivery.
We have to leave it there. Don't get fired. Mike Mayo, thank you so much. Here's the book, Exile on Wall Street. Mike Mayo, look at the colors. They're sort of like a surveillance colors. I like that.